Hello class, this is Dr. Fenton. This is another homework 5 problem in Module 5, and this is dealing with variances. We are going to prepare a flexible budget and compare that to the actual results and then compute the variances. Let's see what they give us. They give us the standards for the company for the year coming up, and it says the sales price should be $36.80. Here are all the variable costs they expect to have per unit. Here are the fixed costs. And now, after the fact, after the year ends, they found out 34,000 books. Produced those. Here are the actual numbers. The actual selling price was $35.80 per book, not the 36. Again, these are what they expected. These are the actual results. They have the variable cost and then the fixed cost. Scroll down a little bit. Required. Determine the flexible budget variances and also indicate the effect of each variance by selecting favorable or unfavorable. Here's the answer. Now, where these numbers come from, of course. What you need to have done on a separate piece of paper is compute a flexible budget column, show the actual results, subtract, and find the variances. And then label those variances as either unfavorable or favorable. Alright, so a flexible budget. As you saw in previous chapters, flexible budgets can be prepared at any level. Here we need a flexible budget at the 34,000 unit level because we produced actually 34,000 books. So what we want to do is prepare a budget, a flexible budget, using these numbers at the 34,000 unit level. And that will show us what we expected to happen if we had that many books that we produced and sold. Then compare that to the actual results at that level, because that's the actual level. So first let's take these numbers. Okay, it's going to be easier than it looks. What we'll do is take 34,000 books, units or books, whatever you want to call them, times each of these numbers, the selling price per unit and these variable cost per unit. You do that 5 times. 1 sale for the sales price, 4 cost. These are variable cost. So $34,000 times $36.80 gives us revenue of $1,251,200. These cost numbers here with the flexible budget, again, just like I said, take each of these variable costs per unit amounts times 34,000. Do that separately for each of those 4 more. Those will be the cost. You get these numbers. Now what we have at this point, expected revenue at this level minus total effect, all these costs, and then we have contribution margin of $377,400. Your sales revenue minus variable cost. Fixed cost, they give us that directly right here. Fixed cost at any level, the budget would have been these numbers. The variable cost totals will change. The fixed costs stay the same for budgeted levels and for the budgets. Drop those numbers in. Subtract. Net income then should have been $202,400 that we would have budgeted at this level of 34,000. Now, what were the actual results? Again, all these numbers are easy to find. Let me go back up to the numbers right here. Take 34,000 books or units times each of these numbers. Actual selling price per unit, actual cost per unit. So 34,000 units times each of these numbers will give you each of these numbers. Your revenue and your 4 variable costs. Once you find that, take revenue minus all your variable cost, that gives you contribution margin. Then for the fixed cost, find out what your actual fixed costs were. You might think, well, you thought fixed costs were fixed costs and they shouldn't change. Well, they will not change if you expect to have these fixed costs. They will not change in a budget. If you prepared a budget for the 35,000 unit level, these 2 costs will be the same. At the 40,000 unit level would be the same. But after the year ends, your actual fixed cost probably will be different than what you thought they would be. You thought they would be these numbers, but they ended up being these numbers. So these are not variable costs. These are fixed costs, budgeted fixed costs, but then your actual fixed cost numbers will probably be a little bit different. Drop these two numbers in right here. Subtract from your contribution margin, get net income, and you're in effect done. Well, almost done. The only step now is to take each of these numbers and find the difference by subtracting these, put the difference over here. Now, when you're finding flexible budget variances, personally, like they show here, I would not worry about plus and minus signs. You're going to evaluate the variance whether it's unfavorable or favorable. So I don't like to do that using plus or minus signs. Just find the difference. So the difference between these two is $34,000, right? Take this from this. $34,000 is the difference. Your flexible compared to your actual. Now you have to determine, is this a favorable or an unfavorable variance? Which is it? Again, I don't like to use minus and plus signs here. Look at what's happening. Your actual revenue was less than what you budgeted at that level. Again, at the 34,000 unit level, these should have been the numbers. Your actual numbers at that level, here are the actual numbers. Your actual revenue was less than the standard called for, the budget. That's unfavorable. You had less revenue than you thought. Let's look at this first, variable cost. Your actual cost here for materials at that level is more than what the budget called for. So you incurred more cost than you should have at this level. That's unfavorable. Whenever you incur more cost, that's unfavorable. Whenever you're short of revenue than expected, that's unfavorable. Labor. We actually spent $132,600 on labor. At this level, we expected to spend $136,000. The cost was less, the actual cost was less than the budget, less than expected. That's favorable. Find the difference, $3,400, favorable. Do the same for each of these and reason it out. Our contribution margin is less than what we budgeted, unfavorable. Drop down to here. Net income, less than we budgeted, unfavorable. For this fixed cost, we paid less than what we expected, that's favorable. So again, subtract and find the differences. Avoid using plus and minus signs here. I don't want that to confuse you. Always reason it out for unfavorable or favorable, depending on what it is, revenue or expenses or net income, and reason it out. Were your revenues less than budget? Unfavorable. Was your cost more than budget? Unfavorable. Was your cost less than favorable? Less than budgeted? That's favorable. Okay. And really, that's it. There's your answer. But you had to go through this schedule to get these numbers for the answer. That's it, and hopefully that helped.